session is on business analysis. What we're trying to put together here is really when you actually tackle a job from business analytical view, how do you actually tackle it? We hear stories of sort of lawyers that are sitting in rooms, they've got to start a file, they've got 4 or 5 boxes of discovery, and they open the first box and there's bank statements and tax returns and whatever it might be, invoices, and you start from the top and you work your way through. And a week later you'll come up with a structure and an idea of what's going on. Is there a more efficient way to do it? Are you actually getting the most out of your business analysis? There's something else you could do that actually could help you get to where you're trying to get to. Sorry? Perfect. We go home now. So today we have your, what do we call? Dynamic duo? Peter Haley and myself, we both work in the forensic section. We've got Ben Gordon, Dan Haynes, Jess, Victoria, put all this in together for us.
We're working to hear some jokes at the start, because of a routine that we've got in doing
Jokes.
No, not this one.
I've got a joke.
Go for it.
How do prisoners talk to each other? On their cell phone.
I'm going to pull out an old one. What happened to the Irish tap dancer? That one think. I like it though. My mother-in-law. And what does the 0 say to the 8? No, it's different dad. No. Nice belt. What we're talking about today. Have we now set the tone for what we're talking about? The purpose of analysis, understanding group structures, the source of information to actually target what you're trying to achieve, utilising data files to actually go through a mild file, actually show you what we can do in a mild file, using trend analysis, analytical review to actually tackle what we do. And this one here is a big part of any sort of analysis we do. And then using benchmark information, how do you know what you're looking at is reasonable? So we'll cover over the next hour. The first one, purpose of analysis. When we actually tackle an analysis, when we're actually sitting down going, right, we've got a new engagement, what are we doing? There's a series of steps we go through. They are, first thing we do, whenever we get an engagement, define the purpose of the analysis. And I'm sure whenever you look at a new sort of legal engagement, you're doing the same sort of thing. From an analytical viewpoint, that's what we're going to do. Where are we trying to get to? What's our goal? Once we work out our goal, the next step is to actually work out how do we get there. So those two are really important, not only from obviously a business analysis viewpoint, but any sort of valuation, loss assessment, anything we do, any sort of engagement, because we quite often get ad hoc of engagement, where we sit there going, how are we going to do this? And always that first question we ask, what are we trying to achieve? From a business analyst point of view, if you're actually diving in, sort of opening the first box, you're looking at documents. What do those documents mean if you don't know where you're going? And that's really a big part of it. Visualise the end goal, where you're trying to get to. Once you've got to that stage, understanding the structure, the businesses and the interrelationships that's there. And we'll talk about that one a little bit further. How does the whole structure work together? Again, if we understand what's there, when we're looking at documents, those documents will start accepting. Plan the analysis. How are we going to do it? What information do we need to be able to do this analysis? This is all before we've opened the box. Then we actually analyse the information. So just got a few more people coming in. Not at all. Grab a seat. Grab a drink. Now we've got some soft drinks. We've got beers, I think, as well. If anyone likes beer. Sorry. Hey, John. Whatever. John.
We're literally on the first slide, so you haven't missed much.
You have missed the jokes, though. We can go back and say them again.
No, I think it's a big no.
They were not worthy of that.
So as John said, yeah, defining the purpose, and if you're doing a valuation, for example, normally you'll say, well, I accept the financial statements at face value. You still do an analysis on them, but you're sort of getting some comfort from the fact that you think they're the starting point. Sort of questioning everything to the nth degree, whereas obviously if you're doing a fraud type thing, well, it's the opposite end of the scale. Not trusting a financial statement at all. So defining the purpose is that broad, understanding where you're going.
We've now got in the room commercial and family. This structure is the same for everything we tackle. So from a family viewpoint, if you're trying to work out what's there, what are you trying to achieve? You're going to have some sort of idea. Once you actually understand the structure, everything's hanging off that. It's almost like doing a mind map where you have your central idea and you have all these things hanging off it. If you take away the central idea, they're just things. So how do you actually bring it all together? It's the same for, we'll go through this one. This one here, always keep a commercial focus, consider whether the early indications that indicate an actual value you're trying to achieve. The easy one here to look at is if we're trying to actually do a tracing exercise. Is there undisclosed sales? Are the actual financial statements correct or not? We can dive in and look, but if it's looking like it's fairly iffy, and if it's right, the amount they're actually going to find is 20 grand, it's not worth going any further. Pull up stuff to move forward. If we're actually looking at this analysis is showing 300, 500 grand, it's worth actually proceeding. So just keep that commercial focus when you're doing an analysis. And that last one is really just sort of backing up this point 6. Don't just launch into it. Know what you're trying to achieve first. Know what you're going to expect as you're going through the document.
I think it's keeping that relativity in terms of, did anyone go to the residential thing, the little thing about the child support? Yeah, at least 50 grand you're chasing. It's not worth it. It's a similar sort of thing with the business analysis thing. Unless you've got a reasonably major sum, you're going to end up spending as much on costs as you will actually finance. So if you're talking about, there's an allegation that it's $100 a week in cash sales not being declared, but it's not commercially viable to chase that rabbit down the burrow, really, I don't think.
Unfortunately,
it's 10,000 a week, different story.
Unfortunately, forensic accounting in the real world is not like forensic accounting in CSI, where they look at a piece of paper and the conclusion they draw from it line.
Actually, just on that, you'd be surprised. It's interesting as a count. When we often get asked about trying to find stuff, information, and someone will ring you up directly, I got the same where they come from. But quite often it's because they've been to a lawyer and they're kind of discussing the lawyer says, well, to do that, you've got to go through these processes. So they don't like that. And so they have this image a lot of the time that the accountants are going to magically kind of go behind the legal wall without the lawyers and stuff like that. And we end up putting them back to you guys and say, well, we can't do a legal thing and stuff like that. But it is interesting how quite often you see hunters off the street sort of things or something, how they have been, you should get the answer they want from the
But having said that, and we'll go through data mining and whatever coming up, but as people have moved into electronic record keeping, our job has become a lot easier because the data is there. I remember doing a job probably 15 years ago when all the accounting records were still manually kept. And Dan, who was here before, and I spent, I think, 6 weeks in an office down the coast, just going through old paper ledgers and journals and things, just looking for entries that just didn't look right. Whereas now, data analytics tools and stuff like that, and I'll run you through how an electronic accounting software file works a little later. You can just see how you can pull reports and export to Excel or export to some other analytical tool sort of software that helps it a lot. So it has to be more cost effective from that point of view.
Saying we've got a job coming up, a farming operation, farm and dad, having blue over who owns the farm with all the stuff that's done, same story. But since 1979, when the son took over the farm, all of the stuff gets entered into a cash book or into later on into financial accounting package. End of every year, they take all the paper and put it in the shed in 1979. And now Dad's saying, those accounts you did are crap. We believe you've been putting here in this code. I don't believe anything you put in there. Now we've got to go to the shed. It takes from 1979, and there was absolutely no order to anything. Paper, top paper, top paper. everything, tax returns, financial statements, invoices, everything's just sitting in there. So we're doing it from scratch, recreating. Our role is actually an accountant on the other side as well. They've got to recreate. We're actually just saying what's the fund's worth, what's it contributed. But Court Mentor's also got involved on another angle of it. But there'll be just that recreation exercise and pulling everything out. I suspect just pulling stuff out and putting it in some sort of order probably has 30 grand exercise. It's ridiculous. And then actually doing the accounts for each of those years, not far off 40 years. That's assuming all the records are there, which they won't. And you can't tell me the rats haven't got in there in 40 years. It's got 200 and they're leaking roofs and group structure.
Luckily, you don't often have to do 40 years.
I've had no hair. So. Group structure. If we're going to launch into it, again, this is all part of understanding the business, understanding the structure that's there. The group structure is really important. What is the group structure? What are the trustee companies? What are the trusts? What are the partnerships? What's the asset holding entities? What's the operating entities? Very importantly, why has it been set up that way? So if we've got property sitting in one entity or plant equipment sitting in one entity with an operating entity sitting beside it, has that been done for asset protection purposes? Have we got trusts involved to distribute to other people within the family unit? Have we got rollover of one entity, one business to another entity because something was going wrong with the legal dispute in place and want to actually protect the business there? Or there's some claim likely to come from an employee. Why have they set the practice up like that? Have we got a developing company that every single project they start a new entity? Understanding why will help actually understand the flow of entry, the flow of transactions between the entities. And it's quite often you'll see each individual entity owns their project, but there'll be an overarching operating entity that either operates all the businesses or does all the administration more likely, and there's charges going back right and there. There's no malice in any of it. It's just how they operate it from an efficiency viewpoint. So understanding that, again, we'll actually understand all the loan accounts that are likely to fly through. Right? So during the year, you'll see that there's lots of drawings, lots of loans building up until a rent or a distribution goes across the other way. How are they actually working that? So understanding how they do it. To work that out, what records are you going to look for? Again, it's targeting certain things. So yes, we're opening the box, but we look at certain documents on the way through. Now, ASIC documents are going to be great. And when you're looking at corporate structure, they're probably going to be the biggest part of it. But they're not going to tell you about trusts. They'll tell you about trustee companies. So you start picturing it all together. Financial statements, again, will start showing you what's been going through, and you look through the balance sheet with the loans between entities. It's going to highlight your entities, what they do, where they fit. ABN searches, the actual statutory documentation, but above all, and never to minimise, discussions with the relevant parties. It really does help.
But having said that, it's amazing how many times you talk to people and they don't have a true understanding of what the structure is or what it is. I had a guy last week who owned 6% of an operating entity, largely turned over at 20 million a year, was making about 6 million profit. And he said, I own 6% of this entity and I want out and I want the other guys to buy my shares. I said, yeah, that's great. First step, of course, you just double check he does actually own 6%. Yeah, well, he owned 6% of the A-class shares. But he owned no ordinary shares. So all he ever had was A-class shares, only had dividend rights. He had no voting rights and he had no rights on capital and wind-up. So his share is really only worth, really at the discretion of the ordinary shareholders, that they will, at their meeting, declare a dividend to the A-class. And for 12 years, I mean, he's been getting 6% of the profits because that was a handshake agreement with everyone. But the guys who originally started it and gave some A-class shares to the management to sort of keep them in as a little bit of a bonus, still retained the real ownership of the thing. So all this time he thought he'd been given 6% of the company. He'd been given a discretion to receive some dividends, is really what he had. So, no, they were given to him. Yeah. But when it started, it was fair, it might make 100, 200 grand a year, so it wasn't worth much. This thing has grown exponentially over time. So, really like the business that did, like I do all the mail outs for superannuation funds, annual member statements, and electronic stuff and whatever. And it's interesting on that, he said, paper, they charge about $1. It's $1 for the stamp, and then about another $1 to actually do the paperwork. So they'll charge the fund $2. It costs them the $1 for the stamp and about 10 cents to actually do it. If it's all done by electronic, they'll charge the fund 10 cents and it costs them about 2 cents to do it. So there's a pretty big profit margin in doing it. And when you start to get some big super funds and things like that, that you're doing all their mail outs for them, it's really just a mailing house, which have moved into electronic. Before, a lot of the old ones that used to be in the paper sphere, these were the new guys on the block who saw the opportunity to move into this, and now they're making a lot of it. I see some interesting little businesses that really aren't that complicated, but just have massive profit margins.
So part of this, and we'll show a quick example, part of this is actually trying to work out what's the extra bit you've got to look at. And quite often we find there are entities sitting around that no one's dealt with for a couple of years now, just forgotten. But you'll find that if you go through the balance sheet, there's amounts owing to these entities that's been used as corporate dump companies to get rid of distributions, mitigate tax. There's loans in between. So if you're actually doing a valuation, it might be that these loans are reduced to the entities you know about. You've got to pick up the other side to get the value. But they don't know, not because they're sure there's analysis in it, they just don't remember. Quite often there's other things there. This is an example we did, and it's still, I'm aware, it's sort of the most interesting and complicated structure we actually have looked at. A guy came to us one year and said, I need you to do an investigation. Something's just not right. He was running a couple of prestige car yards and smash repair yards, which was a prestige car. And that's where he got into the car yards through the dealership. He built it up, very successful, turning over blocks, making about $10 million a year, plus there's another $10 million of rents going across to related entities that he had. So the money in this group was huge. He'd given one of his key employees 5% many years ago, and over time he was aware that the employee had earned the additional 45% was 50-50. This is what we had. He said this was just one corner of this huge exercise. But this was one of the entities. So we had employees entity, our entity, both own 50%, that entity owns the business. Very simple, very standard. Our guy had been running it for 30 years, knew all about it, and knew that he'd actually given 5% of his report up to the 50%. He said, what we need you to do is, and again, this is times that happened to me, you've got unlimited resources to go and actually do ASIC searches and document the structure. But I need every search to be done, I need a certified copy from them. Right? And every single document, you know, the end of the company search, you'll see all of those line items, all the documents that have been lodged previously. Get all of those. So every single document for this group. So we spent $20,000 doing all of these searches. And what turned out is just something we just did not expect. So this is where we started. Keep in mind, this is just the top corner of a huge structure.
And given the ASIC charge about $30 for each time you do one search, so you can imagine how many searches there were for a number of documents.
So what we found is that, so remember, Smith is the employee, Jones our client. Only Smith has an interest in the company, business name, Pty Ltd. The company's ownership changed ownership back in February 2012. The business name, Pty Ltd, is now called Hollow Company. The name of the business is owned by another company now, with different ACM. And it went on. So really what happened is, that was our structure.
What our client thought it was. Yeah.
What ended up happening is that two guys, they both had an interest in Hollow Company. And only Smith had an interest in business name, which had this one. What we picked up was they were different ACN numbers. What had actually happened was, over time, this guy, our guy, was the running everything, managing director, just signed everything put in front of him. Every document we pulled out had his signature on there. But over time, this guy had actually transferred everything across. all had interest in the real property, but all of the business, which was huge, had been signed across. No idea. It was quite amazing. And it all came from, because this guy was a little bit paranoid, everything had to be certified copies. So we couldn't actually rely on the financial statements that had been provided. We had to actually go to the tax office and under frequent information to get all of the actual documents that had been lodged previously. And all the ASIC stuff coming together. It was just a huge jigsaw trying to put together. But it was quite fascinating. But what it was really highlighted is if you're clever, you can start swapping things around. But if you just look at the actual entity name, just do searches on the entity name, it will fall down. You need to search ABS, you need to search ACM. Otherwise, you can miss what's actually going on. If a company goes into liquidation, it's not uncommon to actually change the name of the company. You actually change the name from, it was XYZ business, now we change it to ACM, which actually call it its ACM number. And we actually take that name and put it in the Phoenix entity. So to the outside world, the actual business hasn't changed. How do you find that out? You trace the ACM. When you're looking through, just keep your eyes open. That's the biggest thing, just keep your eyes open. Before we get into looking at a data file, source of information. Getting the right source of information is always, without the information, you can't do the work. So getting the right information is always going to be the important side. You've got your standard information, profit and loss, financial statements, tax returns, data, internet searches. Internet searches are huge. Whenever we do a search, we do the Google search on the company or the business or the people, just to see what pops up. And honestly, 20% of the time, gold will pop up. ASIC searches, property data. We do searches on all the entities we look at. We do a property search just to see what's been going on with that company. Have they actually got anything? Have they changed? Do they beneficially own? What's going through? The company website. Company website will usually have newsletter or announcements on there. Go in there and they'll tell you what the business has been doing. It's usually a great source, but it's just getting some nice information. Statutory documents. Management accounts, again, if you can get into the accounting data file, you can get the accountant's information. There's a whole range of the whole range of things you can start looking at. And again, if you can get that over different periods of time, it'll start telling the story. And that's really what we're trying to put together. What's the story? What's happened? Never underestimate the power of talking to people. When we do a business valuation or some sort of assessment, we always go out and do what we can. We'll go out and do a site visit. And the idea of the site visit is not to do an investigation, it's just to have a look. How's it looking? What are they doing? Walk around the premises. How's it set up? What's the structure like internally? Who are the employees? Getting a feeling of how it's trading. Talking to the accountant. The accountant should be fairly independent. Look at the insurance broker. If we're looking at assets, how much they're insured for, is that relevant? The financier, if we can get the financier's information disclosed, so we'll notice their file. If the client's made a finance application, are they going to tell a good story or a bad story? Get their sort of notes, what other entities they got, what guarantees, what securities actually in there. So try to get everything you can find.
And a lot of this stuff individually might not tell you something, but if you pick up inconsistencies between what someone's telling you and then what a document tells you, that just sort of raises, you might need to investigate that. And that's a lot of the thing, is just looking at the stuff you're analysing.
What we find is when we're doing these big investigations, quite often we get the boxes of information that come through. In those boxes, it's all their notes, it's all of their invoices, it's all their purchase records, all the duplicate things. And there might be other things that are essentially just fluff for what we're trying to achieve. We've got to go in there and say, what are we actually looking for? What are we trying to find in here? Otherwise, it's almost a little bit of a needle in the haystack. That's what we're looking at. These are sort of some of the things, again, from an accounting viewpoint, general ledger, accounting data file, all sorts of source documents in relation to the banking, finance documents, which we talked about before. Then if we're actually doing investigations, things like, depending on what the business is, so if you're looking at someone servicing customers, they like to have a bookings register. Is that bookings register consistent with the financial statements, with what's actually happening? From the point of view that is there lots of people, lots of things there, is there big gaps in it? Are they filling it up every day, therefore working at capacity, or they're not? So the booking register report, purchases, other purchases consistent. If we're trying to actually backtrack to say, all the sales there, is there something in their purchases that's consistent? So Dan Haynes, before he was brought up an example on Tuesday, that his investigation for a Domino's, one of the pizza outlets, and where he started was in the purchasing. He went in and said, right, how many boxes do they order? Every box they order, there's a sale. So here's all the boxes we've ordered. How many units have we sold? Really simple analysis. And what that actually worked out from doing that exercise, there was a huge shortfall in the sale. And they worked out that in that one, it was the manager had 2 tills running and actually ran a second till, and then the second till was white, the first till was declared, and it just went through that way. But by looking at the purchase of boxes, they knew how many pieces had been sold. And he rolled over to do it, their cops and done. So that one there is, so, you know, if you're looking at a mechanic, is there a constant with a mechanic? Is there, how many car washes they're paying a contractor for? So you've got someone who's washing cars, you get paid on a per wash basis. You're looking at a hotel, how many cleans are there? Is there a contractor that comes in and does the cleans? We actually work backwards that way. So that one quite often is a really important one. Then we've got data mining technology. Now data mining is where you're trying to dive into the data file or whatever it might be, and you're looking really at a different way of doing it.
Yeah, so again, with the benefit of electronic records, it's a lot easier to do all this sort of stuff. So what you're doing with the data mining software, and we've got several specific programs that we're using. So a lot of the stuff you can export into Excel or Excel into a format, that's Dan's job, not mine so much, but that then can be analysed. So start by trying to compare it against external data sources, so usually the bank statements. You can run ABNs, the last digit is logarithmically some sort of check digit, so you can run a program to make sure the number is a valid number. And then you can, we did have one piece of software that then launched itself into, does everyone know that you can search by Australian business numbers with the government site? So if you key in the number, it'll tell you who owns that number. So the software will go away and do that for you. It'll compare that. So what you're doing there is things like, you know, it'll look for duplicates of creditor ABNs. So if there's a dummy creditor, so the payments officer is saying, yeah, we're paying for printing and stationery, and they've created a creditor, a supposed supplier, who's actually a dummy, they'll need to put an ABN against it, or it won't be accepted by the accounting software. So you need to have a valid ABN. So they might just pinch one of their real creditors' ABN. So you'll find the same ABN allocated against 2 creditors, and the software will find things like that. Same with employees, if the tax file numbers are doubled up, so if you've got a dummy employee, the software will find that and find you've got 2 employees with the exact same tax file number, 2 employees with the exact same address, for example. 2 creditors with the same address. So these are all people who you pay money to, you're looking for.
With this, if you imagine, if you did this manually, how long would it take to actually go through all of that? When you look at one of your businesses, look at all of the customers, all of the suppliers, all of the employees, that exercise is mammoth. So the software out there, basically you plug it in to the data file, account data file, and just go. So it just runs through, it'll take an hour or 2 hours, and it spits out anomalies. So this didn't look right, and then you go and actually just look at the anomalies. The idea is it actually refines it very quickly down to something palatable.
The first file we ever ran this on actually was the practices internal one, and we our bookkeeper was real good. She had all mistypings of ABNs and all sorts of stuff, so we were coming up with all these anomalies that weren't. We thought, oh hell, then when you checked them out, you just found, oh yeah, you found the supplier's invoice. Oh, she typed the ABN in incorrectly, so it doesn't work.
I remember that it was actually soon after we merged, and we actually found an extra 12 lease payments a year.
That's right, we did, yeah, we did actually, yeah. We had a big merger about 10 years ago with another firm, and yeah, the office manager of the other firm, not our firm.
Should be enough.
But again, because it was only $500 a month back then, in a firm that turned over, what were they turning over, 12 mil or something, you know, no one knows $6 grand a year.
And she doesn't care.
Well, that's what everyone said, that's what everybody wanted. But it wasn't us, yeah, we found it was the old.
We had to decide which financial control we were going to keep. That helps make it.
John mentioned before trying to find missing cash. So one thing you can do is, you know, they still print an invoice or create an invoice and give it to the customer. So the customer thinks everything's fine. But, I mean, I don't know, too many people pay cash so much anymore. It's a bit harder these days. But if, you know, a few years ago, you'd still get people pocketing the cash. The customer never knew any better. They just thought they dealt with the business in the normal course of events. But then that sales invoice would have to get deleted from the accounting system. So you suddenly have missing numbers in your sales number because the accounting system will automatically generate the next invoice you issue has the next number, next number, next number, next number. I'll show you that in a sec. Frequency of similar transactions. So, yeah, if you're finding a lot of people, this is fraud sort of related, and a lot of them aren't real smart, so they pay themselves the same amount, but it's like a lease payment, they just pay themselves the same amount every month. I mentioned earlier about searching for duplicate transactions and things, and looking for payment frequency. So maybe there might be a perfectly legitimate payment for $472.52 every month, but they're doing that twice or something like that. And John will show this thing called benefits law. So pretty well any database, has anyone ever seen this before? So someone discovered this originally a mathematician back in the 1890s, is how long it's been around, and then in the 1930s, another guy had old log tables, these like we used to do logarithmic things, and he found the pages at the start of the log table were obviously being used a lot more than the pages towards the end. So what he actually found was, in any data, and he did all these various testing of it. So pretty well any database, and all an accounting data file is a database of numbers, will roughly abide by this sort of rule. So this is actually if you take the first and second digit. So if the number in the database starts with 10, 11, 12, 13, that's what that is. The frequency of those numbers occurring reduces. So what this analysis tells you is, for some reason, at 50, we've got an anomaly. So all it's doing, again, is just pointing out anomalies. So what you sometimes find when you're looking at a fraud or something like that, someone might have an authority to make payments up to $5,000. You'll find an anomaly of a whole lot of payments in the high 4,000s, and that'll come out in something like that. So all it does is highlight the anomaly. It just helps you find the needle in the haystack a bit better.
And this is actually a job. This is actually an actual job. Actually, we're landing for whatever reason. That was the 4990. But the employee knew they needed approval for payments over $5,000. So under $5,000, they didn't. They paid the maximum account now. That's how we actually caught him. We actually found, we printed, from there we go, that's the problem. We printed out all those for a client down the valley. He had an issue with one of the employees, worried something was happening. So we ran this analysis, my content. And that's what we posted out. So we actually printed out what those numbers were. It was the same number every time. And he was just paying for something to done by the actual amount. I think it worked out. I think it was actually quite a large number, around 100 grand.
Over a couple of years, yeah.
So all of these, you're saying, we've got a few more, but all of these things, they're just different tools if you're trying to get in behind. Now, most of this stuff you're not going to do. But at the same time, just keeping in mind, what's your end goal? What are possible ways to actually achieve that end goal?
So that works with any database, apparently. For mathematical law. So I sort of used, as an example, something I saw recently, I was looking up again, and they had, Twitter followers. So if you have a database of number of people following various people, the database of those numbers follows that rule as well pretty consistently. You'll always have little sort of things. It's not going to follow it exactly. So these little ones here aren't real. That's an anomaly. That's an anomaly, and probably the yellow one and a couple of greens are. But roughly follows that line.
Don't look at say Dan Haynes from our Prince Technology, and he knows how to run software. I'm glad he does, but I don't. Okay.
Hello.
Okay, what we're going to do now is just quickly run through the accounting data file. Deal with we request information, we request the accounting data file. Why do we ask for the accounting data file? There is a whole world of information you can actually pull from, which if you're a nerdy accountant like Peter, he will actually pull a lot of this stuff.
Does anyone ever use an accounting data file? But this is MYOB. It's actually MYOB from about 10 years ago. We sanitised a version for purposes such as this, and it still holds the same. So you see some of the dates are a bit old, but it's not really. It still looks exactly the same. And now you can get a lot of it. A lot of people keep their accounting data files in the cloud, so you don't even have to get the backup or anything, and you can get live data basically, because so long as you get the login details of the password, we can just log in as if we're at their computer or whatever. So whether it's MYOB, QuickBooks, Reckon, there's a few major packages. Xero is another one you might have heard of that small, medium businesses typically use. They'll all look very similar to this because basically MYOB was the first one and the others basically copied it. So what really provided a real emphasis for computerised data files was the introduction of GST. So we've been 17 years now. So most stuff that you'll get across your desk, people have an electronic data file for it. So what happened before that, everyone just used to pretty well pay their bills and everything as they came in, but didn't do a lot of the own accounting in-house, and they just gave it all to their accountant at year end. Now they suddenly had an obligation to every quarter lodge a BAS with their GST bill. So they had to keep track of all their ins and outs on a consistent basis, and it would obviously get too expensive for them to give it to their accountant every 3 months, and I don't think all the accountants around Australia could have handled the workload anyway. So MYOB were the first ones. They saw an opening here, an opportunity. They created the software, and other people followed. So across the top, you've got these various modules. So accounts is probably more where you put journals entries and things that everyone came to our fine financial statements. You remember that, where we talked about journals and ledgers and things? Banking for the most common module people use. So any transaction that goes to the bank, you record via here. So if you're paying, you spend money. That's supposed to look like a check, if anyone still remembers what a check looks like. So you've got to be the check number, and then that'll automatically, once you hit post or record on this, it'll click over to the next number. That's what I was saying before about when you analyse by sales invoices, same sort of thing. If you're entering an invoice in here, the software just automatically clicks over the number, so it's automatic. You put in the date, you put in the amount, you put in the description. And then again, if you think back to our understanding financial statements, and we spoke about the classification where you had any transaction, you've got to decide, is it expense, is it revenue, whatever. This is where you do that here. So the software knows we're paying from our Metway check account, so you can see it is a bit old, on one side, so that'll be the credit side of the entry if you're talking journals. And then you've got to tell the software, you can do most of it, it'll do all the posting, but you've still got to tell it where to put it. So you get a drop-down menu of all your various expenses here, and you tell it, for example, we're buying some stationery, use account. And then you key in the amount, you hit record, and then that posts it into the ledger in the background.
Put the payees in as well, so it'll be all your suppliers.
Yeah. So as you get a new supplier, you can enter a new one, and they will form into this database. Sale, same sort of thing. Enter a sale. That's where you put in, so that's your invoice. But it also allows you to do it as a quote, which you can then later convert to an invoice and things like that. So that's one of the, if you're doing an analysis, sometimes you pull out all the quotes, for example, and see how many have been converted to invoice and whether that's a consistent sort of pattern. If you're suddenly not getting so many converted, maybe they are doing the work, but not recording the sale as an invoice. So again, you put in the customer, you put in what you sold them, same sort of thing. You can do time billing, so some small professional service firms, for example, run their timesheets through this, you can do that. Purchases, same sort of thing, so pay bills, put in your supplier, you tell which account you want to pay it from, so on. Payroll, so that's where you run all your employees, so that's why you've got all the data in there about who all the employees are and why you can check them, because it's all done through the software, and stock you can trace through there. So that's how you actually record everything. Then a lot of the stuff we do, even if it's just a valuation, we might go in and say, right, well, in reports, all those things, there's a whole lot of different reports. So the common ones in accounts, so that's where you tell it, I want to print a balance sheet, I want to print a profit and loss account. Maybe I want to do a multi-period, and we'll do July to June. So that's where you do, well, I'll look at all my sales on a month-by-month basis. Maybe I can export that into Excel and just see where the trends in the business are. So it might just be a valuation that you're trying to work out if there's some seasonality in this business. If it's in retail, you'd expect, November and December, to a lesser extent January, to be big months. And if that's not happening, you'd be wondering why.
So this is where we go to for a lot of the representations that one of the parties will give us. We're going to do a site visit. Oh, it's terrible. You wouldn't believe what's happening. We've fallen off the cliff this year. There's absolutely tall and no contracts. It's terrible. So we have a look at their financials, and sure enough, it has been bad the last couple of months. We do a lot of the analysis. We can see things were flying up to Christmas. Fantastic. They're supplying toys to retail stores. November's fantastic. December starts going off. January's horrible. Yeah, you're right. There's nothing here. So we compare that to the prior year. Same thing, pulling out these results. And we can see that it's traditionally seasonal in this way, and that it's poor in December. January, it starts building up through the year. So what they're experiencing now is the same as they experience every year, and it's not falling off the cliff, it's just the seasonality. So we can check the assertions that are actually being given to us by various people.
I remember Ben had it's an IGA supermarket in a reasonable sized town, not too far from Brisbane, but it was the only supermarket in town for a while. And Woolies moved in, say, in October, decided to open up down the road. So obviously, all the previous year's sales, and suddenly you saw, maybe they're doing $500,000 worth of sales every month. And suddenly in November, once Woolies opened, it dropped to about 300,000. Well, might have got 400,000, 300,000, and then it just kept going at 300, 300, 300. And we had about 6 or 8 months, didn't we, since Woolies opened? It wasn't that long. Instantaneous, yeah. But interestingly, we thought, okay, Woolies was a super IGA, it was a similar sort of thing. So you almost had 2 supermarkets of identical size, same sort of range and everything. So you'd think the expectation would be the sales would halve, because you think the town only had a certain population, and maybe half the people go to Woolies, or more than half would go to Woolies in this guy's sales, but they only dropped by about 30%, which was interesting. But it seemed to find its new level at 70% of its previous. So in doing a valuation, we then assumed going forward, it would have ongoing sales of about 70% of what it had done.
So if we're doing family law a business valuation, this is goal to actually work out, we're trying to work out where this is going in the future. We've got one party telling us it's terrible, one party telling us that, this business has all our lifestyle that's really good. We're going to come back with an assessment. How do we do it? We can get in behind the data. And this stuff is just really quick to push out. We just dump this straight into an Excel document. We can quickly whip around and see exactly what the trends are.
That one was actually a bank panel job. We were doing it for ANZ or Westpac, I can't remember which one. And he owned a couple, and he was buying another one, and he wanted to use this one as security. But it was obviously very relevant then what this one was worth in terms of being able to afford to buy the new one.
Which is interesting, because it was a bank sale job.
Yeah, about 4 years. That was about 4 years ago.
And now it's come around, we're doing
divorce.
now 7.
Oh, yeah, 4 back then, now you've got 7. Well, that's funny you say that. I won't mention the towns, but they're sort of, he's got a few out and around, within 100 k's of Brisbane that Aldi has entered town.
So this analysis is from a damages viewpoint. Again, it's goal. We look at the analysis. The assertion is that we were trading really, really well up to a point, and then the damage then happened, and we're big credit. Well, is that consistent with your trying to actually get that opinion as to where the business would have been but for this stuff has gone.
Amazing the number of times you look at someone says, oh yeah, we had an incident, something happened to the business, the incident itself in December, and so you see these accounts, the annual sales drop right off. But when you actually look at them, it's amazing how often you only see the sales was dropping off 3 months before. And so it's, something else. To be honest, a lot of times people themselves have got no idea it's the actual claimant.
I think it's dead right, and that's what happened at the start of the GFC. GFC, I think the stock market crashed in November 2007. March 2008, we found a lot of businesses started to turn. Construction companies with that contracts in place took a lot longer. Something like retail stores sort of tend to turn down in that February, March 2008. However, if you look at their 2008 results, because the economy was just flying along so well up to that point, you look at the results of 2008, they were better than 2007, even though the business was falling. If you actually try and do a valuation, you've been using the historical financial statements to predict the future, just by looking at the financial statements, you would have seen the expected business to go like this. By doing a trend analysis just like this, multi-period analysis from their accounting data file, you can see they were turning off. It gave you the highlight of the area you need to investigate further.
Other big ones we often sort of get reports out of this are things like sales. So you can do sales by, if you're looking at other debtors recoverable, just do an aging detail, 30 days, 60 days, 90 days, that sort of thing. And again, if you've got the file, you can run it at any date you want. You just tell it where you want to do it. So it might be the current date. Maybe you're doing a valuation. There was a partnership split 16 months ago or something. So you can try and work out. You can look at all the sales by item. So where are they making all their sales? John's got one at the moment. They've got a right to sell, what would you call it? Backhoes, I suppose. A certain brand of backhoe. Construction works. But it's not an exclusive thing. So when we went into the sales summary and sort of having a quick look at the business and seeing what are the main products they sell, that 90% was this one brand of backhoe that they haven't got an exclusivity for. And the guys in New South Wales and Victoria who previously had exclusivity, nothing in writing, but they, for the last 20 years by handshake, always had the right to sell this thing. The importer, the Australian-wide importer, had decided to start letting other people sell this thing. And there were noises about it happening in the Queensland operation too. So what's the effect that's going to be on his business? And so it's a big risk. So often we look at these sort of things in terms of trying to gauge the risk involved in the business. So if you've got a big dependence on one particular product,
just on that one, just to highlight it, they're turning over 42 odd mil, they're currently turning over 42 odd mil. If the prediction if they lose the gross profit margin or sales, it's the same cost, just lower sales for each item. If they lose that same, they expect to actually lose from a sales point of view, their $6 million profit will go to zero overnight. So if you're doing a $6 million business using a 4 times multiple, $24 million in value, or nothing. Just based on this agreement. So we often look at the business is all about sales, yes it is, but quite often it's all about the purchases and actually the key suppliers can you retain those?
Same sort of thing, you can do a report where you sort of look at, have they got one big customer? So that one was, one big supplier basically. They relied on that supplier. So that's just an example of the sort of, each of these tabs have, a dozen, 2 dozen reports you can run on all various different sort of things you wanted to. So in terms of understanding the business,
all of that stuff that goes in, and the reason we showed you the data entry, all of that stuff goes in can be reproduced in some form of report way out to an analytical. You just to work out what's trying to achieve. The important thing about these though is the actual accounting data file is maintained is as good as the person who's entering the data. So if the person entering the data has no idea, so quite often when you're looking at management accounts, which is the internally prepared stuff, quite often they don't match the externally prepared stuff from the accountant. The accountant takes this file and then cleans it up, puts it through other files.
as a minimum, we'd go in and reconcile. Does everyone know about how you reconcile with the bank? So you make sure all the transactions in here are identical to what's on your bank statement. So that's your first level of comfort. At least the bookkeeper has managed to make everything agree. These days it normally does, because what you actually do, you duplicate the bank because you've done an export these days. Yep. Checks. Yeah. It's really what's on the bank statement is what is. So I'll just get you back into the screenshot. Yeah.
Okay, the next one is just because you guys don't look a bit tired. So for you, in your notes, in the back of the deck, not in the actual notes behind, you see a profit and loss statement. I don't think it's been good to work. Not so at all. Whenever we do an analysis, the first thing we do when we get hold of financial statements is put in some form of what we call a trend analysis. We try to put it in a format we can actually compare each of the years. So we put it in, we'll always ask for the last 3 years on week-to-date financial information. So from a profit and loss point of view, that's a summary we put in front of you. It's what we call a trend analysis. You can actually just look through and see what trends there are. So this is a business evaluation we did a few years back. It's been changed obviously. Business has been running for about 20 odd years. Standard trading terms, 5 customers. One of the directors exited the business in 2015. 2017, that director who exited says, you know what, thanks for the dividends. I now want to, thanks for the joy, the ride. I want out, I want to sell my interest in this business. We've been asked to value the business as at 30 June 2017. So we've been given some financial information and we've gone through that. What do you see in there? So this is going to be part of that analysis. This is exactly what you want to try to do. Which one is looking at this? Yep. Oh, in 2017, the salary's gone through the roof. Yep. What else? Lease expenses. Yep. Advertising promotion. Yep. So you ask the director what's going on. He tells you we've changed the way we're doing this business. We're trying to promote sales, and to do that, we've put a few measures in place. And they've hired your bookkeeper. Extra maybe. As part of what we've done, we've tried 2 things. Firstly, we've dropped our price, and we're actually trying to do that Woolworths approach. Drop the price, get more sales. And we've sort of just started that. You'll see our effect on the actual gross profit there. And also we've got the marketing person in place, salary in place there. We've got to drive around the car to see his customers. But we've changed the way we're doing our advertising.
Your superannuation expenses is 15 and 16 greater than your salary expense.
How much super do you need to pay each year? 9.5% of the salary then. Less than that. I can't even. Less than that. If you're seeing in a private company, if you're seeing super through the roof, what's it likely to be? The owner's putting super in his own account. Yeah, exactly. So there's probably going to be a self-managed fund associated with this. You'd look out for that. There could be another entity. What's you said their purchases have gone up, so that went up to 120. What's that? Is that purchase of their own stock? So they're paying more for their stock? Is that right? It'd be external stock. Yeah. Does that mean that the cost of whether they are buying has gone up, or if they're buying more of it, or good questions? The things you'd ask, you'd investigate. You probably compare there to, they may have bought a lot. Are they doing this Woolworths approach where they're now carrying more stock, so their closing stock going up? What else would you look at there? So just to keep that there, they're all sort of things you'd highlight, absolutely. The trend analysis just basically see, is there anything that's actually standing out you want to make an inquiry? So you've picked most of them. You haven't talked about sales. Yeah, I was going to say, well, the sales are flat, even though they're spending all that money on advertising, it's not producing any increase in sales. But if they're dropping their margins, are they selling more to actually get the same? It's got a margin squeeze. That's the answer you're given. What's the big thing you're noticing here? And the bottom right? Above that?
So they're making out like 150,000 each year, and then they make
things are tough out there. Things are really, really hard. It's really hard to make a buck out there today. You wouldn't believe what it's like to sell things out there. No one wants to, so much competition. Things are hard. So we're trying something new, but geez, the effects in the short term, Hopefully we'll punch through it, but I don't know if we'll make it.
So this is the director who's staying on talking, go ahead and work that out.
And that, I mean, honestly, 3/4 of the jobs we go to actually do evaluation, that's what the response we'll get from the person. You get told all of the terrible things that are about to happen to this business, things we're going through, why there's no future, why the business evolves around me, business is nothing without me, the contact of me, they're going to walk, the implications of that.
Is this in the context of family law?
That one was a family law, but no, this one here we're actually saying
This
it's
one.
direct leading. One of the shareholders.
Oh, I see. Yeah. I was going to say, if you look to sell the business, it's the opposite. It's going well.
Okay.
When you buy it.
Yeah. And the bank valves, yeah, they're often trying to sell, so you talk to the vendor or you're talking to a lot of the time there because they know the business and they talk it up. But you've got to keep that context of who you're talking to in the context of the matter, so you have a level of suspicion, I suppose, in terms of they might just be not telling the whole story. They mightn't be telling you lies, but they might be.
Have they got an agenda?
Yeah.
One classic, just we've seen a few times, but it's important to be aware of this. It happens in a family law context, but it's quite relevant to any business to see, is the issue of provision for annual leave and for long service leave and that, because one thing is that if you argue for a party that's buying or selling, the annual leave and long service leave will come into it at some point, but it's not usually put into the financials. So you've got to always be asking about that. But a classic in family law often is something like we got the other day, you'll see in the current year's profit. They've never recorded annual leave or long service leave before, but there'll be like this big provision, annual leave expense and long service leave. And that on the balance sheet will be this liability all of a sudden for like 100 or 200 grand. And that will usually be, they might be bringing to account the employees for the first time, but quite often, and we've seen this in family law things, if you had a family-run business, and say you've got husband and wife and maybe brothers and sisters and stuff like that, we have one few where they all worked in the business for like 20 years, and they sort of had a gentleman's agreement that they just, take leave whenever they felt like it, they didn't record it. But then suddenly they come to this family law dispute, and the poor old spouse of the family members trying to, have a family resolution, and the husband owned a quarter of it. So they've obviously had a meeting with the accountant and said, how can we knock down the value of this business? And so then all the family members have each recorded like 20 years of long service, 20 years of annual leave. Well, the husband owes like $200,000, and his brother is owed $200,000 and all of that. And all of a sudden everything goes down the drain. But it happens quite a lot. So whenever you see that financial and there's the provision for employee entitlement that go in, you always want to investigate that and understand who's it can be pretty tricky to deal with that.
Now, so that's profit and loss statement. The next thing you've got in there is the balance sheet. So from the balance sheet point of view, what else can you see in this business? Probably a couple of bigger items here.
Are we looking at what part? I'm sorry.
No, let's look at the balance sheet first. Just ignore the one we just gave you. What can we see in the balance sheet? I'm telling you that as director, the business is really tough. It's terrible. It's going to the dogs. Is any of that supported in what you see in the balance sheet? Definitely the profit and loss. We can see the losses coming through, although you're a little bit suspect that some of the things that are being paid. Yeah. What would that be? So he's working in the business, he gets back to the balance sheet. It's often important to look at both at the same time. In those years, the loan is growing quite high. That's an asset loan account. This amount that is owed back to the company. How much is he paying himself in those prior years? Now, he's got an employee in there as well, Thynne. How much is he paying himself?
That means living out 200K a year for himself.
Yeah, absolutely. Well, if your loan account's increasing, yes, he's taking it as drawing. But is he paying himself in those prior years? On the profit and loss statement, can you see any sort of big wages going through? But you can see a bit of super going through. You're starting to get a little bit of a picture. This is a private company and there's personal stuff that goes through. You'll also see in that a little bit of cash has turned in the last year to an overdraft. You'll see the new leases in there for the motor vehicle. So you're starting to put together a little bit of picture of what you're probably going to note in there is the cash flow probably is a bit tough in this thing, but he's still been ripping out his money. What's his loan account done in the last year? So I don't like it's cruise, you can't hear me, I'll say that again.
Well, it's nearly doubled its fee.
Yeah, so what's happened that last year? Hasn't really gone up by much.
Well, not as much as the previous year. Yeah.
So it hasn't gone up by much. What's happened with salary and wages on the other side? It's increased a lot. So he wasn't paying himself, the loans increased.
Well, he was taking cash, but he wasn't taking it as salary. So the cash was still leaving. Remember, you always got to have two sides of the entry. So you've got bank account getting effective. You've got to have another side of the journal. It's either got to be a salary or it's got to be a loan in this case. And in the current year, he's trying to manipulate things to show.
Where did the cash actually come from, though? I mean, some of it's coming from the overdraft.
Yeah, yeah.
It's coming from the business as a whole, whether it's trading or whether it's from just sucking the assets dry or increasing the liability.
I mean, the physical thing, it would come out of the bank account. There would be an actual transaction from the bank account to his bank account, the company's bank account to his bank account. Yeah, and whether he classifies it when he's sitting in his MYOB screen and you've got that little drop-down menu, do I say salary and wages expense, or do I say loan W widget? Yeah.
So what you're sort of seeing there in that last year is the loans aren't really increasing, but historically he's been taking money out, which sort of makes you wonder, salary and wages, who's salary and wages?
That's right, we'd have to drill down into that.
Yeah. So it's probably going to be him as salary and wages. Who's the marketing person he talks about? Him, his wife, but someone, it's basically someone related. So it's likely to be him. So if we just follow this train of thought a little bit further, so that salary and wages is him. So he's the marketing person. Who's the car? Him, girlfriend. Most of us, at some point in time, have leased a car. How much are the lease payments per month? $600. How much are the lease payments for a year here? Profit and loss?
19,000, so he's driving a
Actually, it wasn't. It was a Mercedes four-wheel drive.
In a
We
family
paid a year in advance at 32. So just start putting some of those things together. Try to see the story. Now, the next thing you can do is start doing what's called analytical review, which is the sheet you just handed out. What analytical review is just basically trying to compare the numbers on like-for-like. So the first ones, which are your, up here, your profitability ratios. The first one there under there is gross profit margin. Always do this. This one is goals. So your gross profit divided by your sales. Your gross profit divided by your sales should remain relatively consistent year on year, unless there's a fundamental change in your business or something's wrong with the way you're reporting. So in this case here, 66, 65, 54.
So you might see a 2 or 3% variance from year to year because your prices, your suppliers might change their prices and you don't move yours quite the same. And little things, but a 10% variance.
You raised purchases earlier. There it is. There's a big circle. So you're circling that. What's happened to this business? Net profit margin, 36, 34 negative. Circle that. What's happening to this business? Return on total assets. If that interests you, again, it's gone positive, positive, negative. Why? What's happening to this business? So there's something major happening here. We don't know what it is. Activity ratio tells you how long it takes to do that item. So stock, how long does it take you to turn the stock over that you're holding? So what you've got in your warehouse, how long does it take to turn it over? 231 days, 207 days, 140 days.
That means he sounds like he's just dropped the prices on his stock, doesn't it? Because he's turning over his stock a lot faster, or he's just not.
What else could it be?
He's drawn down. He's making
So you raised it before. We've got all these purchases, but the stock hasn't changed. All the stock there.
So there could be 2 or 3 explanations
So
for
what
things.
are
You've got to
you
look
getting,
at
say, invoices?
How do you work out how much stock you've got at year end? You do a stock table. How do you count your stock? Oops, missed that one. You manually put it in your account. And
Do you remember that, understanding financial statements, we spoke about stock manipulation and how you can value your stock at different things and how the higher your closing stock figure, the higher your profit will be. So if you can manipulate your stock value, whether legitimately or not, and we'll come to an explanation, in this case it wasn't, but you can manipulate your profit. So stock will affect your profit and it will also affect your balance sheet because you haven't got as much value on your balance sheet.
And we won't go through the last
So
one.
in this case, he paid a whole lot of money to stock, but at the end of the year, the stock's worth less than what it was previously.
Yeah. Well, that's what the financial statements are
That's what
telling
it's,
you.
yeah, that's what it's indicating. Day-to-day is how long it's taken to collect from your debtors. So it's going from 2 months up to 2.5 months, almost 3 months. And creditor days is going from 146 days down to 117 days. So it's collecting his creditors faster, which is a little bit odd. Sorry, paying his creditors faster, a little bit odd given the base saying with cash flow problem.
Cash flow problem.
But he's paying his creditors faster.
The cash flow problem.
Liquidity is how much working capital you've got in your business. So current ratio, you'd want sort of up around that 2, quick ratio, around 1, which is not too far off though. Leverage ratios, how much debt to equity you've got in your business. So there's a few things that are highlighting there. So again, all we're doing is creating a list of things we need to investigate to get a proper feel of how this business is going.
Those liquidity things, they're something you do look at as well when we do solvency reports, so, commenting on solvency of businesses and cash flows and things like that.
So what should that ratio be? The current ratio?
Current ratio is like to be above 2.
And quick 1. Yeah. It really just means you've got enough cash, ready cash, to be able to pay your creditors as and when they fall due.
But that current ratio is your current assets divided by your current liability. So basically, you're trying to say you can pay your current liabilities, the debts you've got coming up in the near future, you can pay those with the assets you're going to liquidate that will actually realise in the near future. But if you actually look at the balance sheet, what's the primary asset, current asset? So you can say using these to actually pay your liabilities. What's your primary current asset? The loan. How liquid is that?
Depends on whether he's got the money there.
Yeah,
Correct.
exactly.
But if you take that out, what's your current ratio looking like? Crap. So what's your business doing? So they're just things to look at.
And in fact, if you take that loan out of the balance sheet full stop, your net asset position doesn't look very good from memory, does it?
And what you'll see, you realise when the profit he's taken out of business every year, which is pretty common for small business. But the profit he's taken out every year. First 2 years, he put it through as a loan because he didn't want to pay the tax on it. The last year, he put it through as an expense because that reduced profitability because he didn't want to pay for the company. It's probably closer to no. But when we actually go through, we did all the analysis investigations. That's that last page that we just handed out. Report of operating profits up the top. We did the adjustments on the car. This was for evaluation, so we're actually trying to get this on a commercial basis. He needed a car to drive around in, and he needed to actually take his stock around and customers and see. He didn't need a Mercedes four-wheel drive, he could have had a Commodore or whatever it might be, or a wagon. So we said about $30,000, 5 years, with through depreciation for a standard vehicle about $6,000. Then we added back the actual cost of leasing. So we had the interest on the loans for the, we also added back the financing, which is interest on the loans. We added back the leasing charge for the new vehicle and took away a sort of standard vehicle. There was a shortfall on sales. Every year he had been profiting $25,000. In the last year, he profited $50,000. Now again, we saw the sort of gross profit margin change. That was contributing to that.
He just wasn't recording $50,000 worth of sales. He was just going to the state deposit box.
He was selling to people for cash. Obviously, still putting all the stock through the business. The purchase through the business. The next one was additional stock. You do your stock take at year end, you walk around and you counter your stock. But what about the stock you've purchased but hasn't turned up yet? So you put it through as an expense, which hasn't counted. So there's a truck waiting to actually come in, still at the warehouse coming in the next morning, $20,000 worth of stock sitting there.
So it left the supplier's warehouse on the 29th of June. They issued an invoice dated 29th of June. He entered that in his mile that he made that purchase, but the stock wasn't physically on the premises because it was still on the truck. So then it got counted.
So this is an actual job. So it does happen. Then for a commercial remuneration, we actually ripped out all the benefits he received over the years and put through a commercial amount for what he was doing, which we put through at about 70, with the latest year, 77,500 plus super. We added back donations. They were goodness of the heart donations for season, wasn't actually business expense per se. The other one which you raised with advertising has gone up. Advertising had changed a little bit, where they were spending local rags, but the main part of that advertising over the last year was actually legal, personal. He just miscoded it. The P went through and just said, you put it all through, you decide which account you put it to. He just put it to advertising, not to legal. Changes the result. And that's the thing you've got to be aware of. If it goes into the system, you can trace it. You've just got to know what's looking off. And when you looked at profit and loss statement, you'll highlight it. The first question we would ask, innocently, is what's changed with advertising? And then when we go into the mile, we'll actually go, if you actually go into that mile for that file, you can see who it was being paid to. Legal firm, wasn't it?
Yeah, he didn't hide it very well.
So once we have to normalise these earnings, 153, 150, 130, the business had deteriorated in the last year, but nothing like what was being represented. And that's most of that came from a single payment. So there's one more thing we've just want to quickly go through is business benchmark.
So there's another handout there, the one that's stapled. So that's, I know we're running out of time, so it's got a bit of an explanation of how it benchmarks. So when John was speaking about those ratios, the other thing you can do is compare it to what other similar businesses are doing. So that's just one service we subscribe to. Tax Office website's got some benchmarks as well. We've got a database of our own for certain industries. There's a lot of valuations of where we sort of know what the norm is. Pharmacies, supermarkets, Domino's, pizzas, we do a lot of. The stuff we do for the banks, where you tend to get repeat engagements on the same sort of stuff. So, yeah, we don't do 7-Elevens anymore. No one lends on them. So seriously, you can't get finance on a 7-Eleven anymore. So, yeah, you can buy a lot of things anymore.
So these benchmarks are just a collation of actual businesses that actually are trading in that area. So keep in mind, the benchmarks give you a really good guide as to what a business might be doing in that area. So for an accountant practice, you might have 35% wages. If you're sitting in a retail shopping centre, rent might be 15%, where whatever it might be, there's sort of guidelines. It's a guide to actually go through. So if you're actually analysing this, it gives you a bit of a guide as to what you should be doing. It's not gospel.
And their averages, so the range might be here to here, and if you're sitting here, well, you're still in the range, but you don't know that necessarily from the benchmark. But all it's going to do again is it's another thing to look at, and potentially, is it something that's abnormal? You can investigate it. No, it's not abnormal. There's an explanation as to why he's a little different to average. That's all he's doing.
Every business can operate its own parameters. This just gives you a guide. It's quite surprising that if you look at something like a standard business in a retail shopping centre, it's probably closer to something like a professional services practice where there's a lot of variability in how it operates. I know it's late, but we've got some valuation forms there. That's what we want to go through today. Those valuation forms, the big thing we're looking at on those valuation forms down the bottom, we're sort of just putting together some ideas for next year as to what we might talk about and what we're thinking of doing for next year is twofold. One is actually doing some seminars. We actually just have random ideas, random questions. So we had one the other day, tell me about personal goodwill, and also tell me about tracing money. So we're looking to actually do a couple of those sort of more practical type sessions.
So they're probably things that won't go for a whole hour, or they'll just spend 15 minutes on and do 2 or 3 in that session. Yeah.
On the other side, we're looking at running some young practitioners sessions where we actually go through some more basic stuff on a workshop type format.